Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I am very excited for this episode and for this week. We're back with another installment of ASX Week. It went so well earlier this year that we're doing it all again. We're going bigger this time across Equity Mates podcast and Get Started Investing podcast. But to kick it off today, we've got a returning favourite from the last ASX Week.
That's right. Friend of Equity Mates and a guest that we've had a lot of people ask to return, and it is our pleasure to welcome Anthony Doyle from Fidelity. Anthony, welcome.
Cheers, gents.
So today we're going to be discussing really everything that's going on in markets. You're a cross-asset specialist at Fidelity, so we're going to ask you all the hard questions.
Nice. Yeah.
Great. Fingers crossed you're across it all. I'm sure you are. For those who are joining us for the first time, the ASX week is now spread across a full month. We've been lucky enough to partner with some of the key presenters, but there are plenty of more presenters as part of the ASX week. So to get access to the videos that are available for a month, head to www.asx.com.au/investor-day. Confusing URL. We'll put it in the show notes.
Yeah. Just follow the link in the show notes. You need the 2 in the link.
Yeah, I know, it's ridiculous. But anyway, let's get stuck in because there's plenty to cover with you, Anthony. And let's start with the thematic of this time is different. In your presentation, you mentioned the 4 most dangerous words in markets, which is this time is different. You were using that to explain how the post-COVID market is different to the post-GFC market. So can you explain some of the key differences that we're seeing here?
Yeah, I mean, we've had 2 once-in-a-lifetime events within the space of 12 years or so. And I guess I was referring back to the GFC as, despite it being in 2008, 2009, it still looms large in a lot of investors' minds because of just how uncertain and volatile the environment was back then. So I had a lot of fun times working on a bond and currency desk in Dublin with exposure to Lehman bonds and exposure to a whole heap of leveraged loans and going in to talk to clients and explain why their fixed income funds were down 20-30% over the course of a couple of months from what are so-called defensive assets. And it's only when you look back at these seismic events that occur, when you look back and analyse what had occurred or what has gone on, that you realise that there are some significant institutional changes, and it can be quite difficult for us to assess that real time as we're living through it. So if you cast your minds back to 2008, 2009 and the decade that followed, when I talk about is this time different or this time is different, I'm talking from an institutional standpoint. So very much the name of the game in 2009, the recovery phase that the world went through, there was so much focus on debt and concerns around government debt to GDP. And that flowed on through the middle of the last decade into the European debt crisis and the ability of sovereign nations to repay their debts. This time around, there's no concerns around that at all. So, the name of the game last time was austerity from governments, fiscal austerity. And when I say austerity, tightening the budget, tightening your belts, trying to move into an area where you can start to service that debt and actually retire some of that debt, get the debt to GDP levels lower from the government. This time around, globally, you're looking at fiscal expansion. You're looking at government stepping in to the void that has been caused by lockdowns and this pandemic, stepping in to support their respective economies right around the developed world and the emerging world to some extent. Now, this is really being led by the US that are doing huge amounts of fiscal stimulus to the tune of almost $9 trillion by 2025. But it's also followed on from Europe, the UK, and of course, bringing it closer to home. When I returned to Australia in 2018, 2019, there was this fixation from the coalition government on a balanced budget. That's really out the window, right? So we've got an election next year, and there's going to be lots of goodies for everyone, I'm sure, because there's not this fixation on having a balanced budget, living within your means. The government has rightly stepped in, and one of the key policies of the last couple of years has been JobKeeper, for example, in order to support the Australian economy through this extremely difficult time. And so when I say this time is different from a fiscal stance, we've moved from austerity to one where the government is expanding its balance sheet, but also on the monetary side. So when we talk about monetary policy, interest rates, in terms of looking at what the RBA did in the last crisis, they only had to reduce interest rates a couple of times before they started increasing them again. This time, we're at the party with everyone else in the zero interest rate world, and we're drinking from the Kool-Aid. We're drinking from the punch bowl of quantitative easing, of yield curve control, of money printing, which is quite a different environment to moving traditional interest rates up or down depending upon whether inflation is rising or falling or the economy is expanding or contracting. And you're seeing some, obviously, what we've seen mostly from quantitative easing is financial asset price inflation. And I'm sure, you gents are very aware of what's going on in the housing market, but of course, this has impacts right throughout all equity markets, risk markets, corporate bond markets, as people look to generate returns that they once enjoyed simply from saving, right? The online savings accounts, which had a 5% interest rate or a 6% interest rate, that's the environment we lived in after the GFC, maybe a little bit lower, 4%. Those days of term deposits generating any sort of return close to what inflation is are long gone as well. So on the monetary policy side, we've seen an evolution from a fixation, a focus on inflation targeting, to one where the RBA is now very much focused on the labour market, generating a strong labour market, so unemployment rates fall, so wages begin to pick up. They want people to enjoy real wage growth and make this recovery as inclusive as possible, as opposed to the post-GFC world where the people that did well out of policies like quantitative easing are those that own assets. The people most impacted by the current COVID environment, pandemic environment, typically people on lower incomes that maybe don't own their home, maybe don't have big equity portfolios or superannuation funds, and have been put at home because they haven't been able to work in hospitality or services. So the RBA wants to make this recovery as inclusive as possible. So they're really focusing on wage growth. So that's how the environment is quite different this time around, as opposed to what the status quo was post the GFC.
Yeah. So I guess the red flag that comes out of that, or the concern that comes out of that, is post-GFC, we saw a decade-long bull run in the stock market from 2009 to 2019. It was great to be in equity markets. If this time is different, does that mean we're not going to see a decades-long bull run out the back of COVID?
Now, I'm quite bullish on risk assets long run more generally, and have been consistently since we saw the pandemic hit. Even in March, April last year, long run. I was telling clients and talking to clients saying, it's 50-50 if the Aussie equity market is up or down this year, but I can tell you in 7 to 10 years' time, the Aussie equity market will be much higher than where it is today. Now, the danger that we're in today is that as the world has become increasingly leveraged, as the world has become increasingly financialized, and as we rely upon rising asset markets so much to fund our retirements and fund our lifestyles, is that when you get any sort of whiff of the monetary punch bowl being removed from the party, investors have a tantrum, whether that's in bond markets, the taper tantrum, or in equity markets, the volatility that you experience. And inevitably, because of the impact that falling asset prices can have on people going out to consume, and they become more worried, more concerned, they tighten their own household finances, they don't go out and spend, you see that central banks are really forced into a corner, and they don't act out on their preference to raise interest rates. And we saw this in 2019 from the US Fed, which was called the power pivot. We saw this from the RBA, where they were telling us in 2018, 2019, they were going to hike rates, and they ended up actually cutting rates after we had the election result of the last election in 2019. They came out, the election result was on the Saturday. They came out on the Wednesday and said that they wanted to cut interest rates. So I think that the conditions continue to be fertile when we have so much liquidity in the global economic system, while central banks are as dovish as they are. And whilst we have this technical, what we call a technical shift out of cash, money market funds, term deposits, this money looking for a home, and to use an acronym, TINA, there is no alternative. Because what essentially central banks have done, what the RBA has done to all of us, is remove the power of compound interest. The eighth wonder of the world, reputedly Einstein said that. They've removed the power of compound interest from savings, defensive assets like government bonds, because yields are so low. And additionally, they're more willing to accept higher inflation. So what's the point of parking my money in a savings account yielding nothing, and inflation is averaging 3% a year for the next decade? I'm going backwards when I take my money out in 10 years' time, or I'm saving for a home, or I'm saving for retirement, or I'm saving for a car. So essentially, investors are looking at where are those asset classes where I can generate a return above inflation. And they move into corporate bonds, and they move into equities. They like the income that you can generate from hybrid type assets or from equities, the franking imputation benefits of that as well. So it's really quite an interesting environment, and essentially the tail wags the dog today, because economic growth, we've got this fixation of continuing to drive economic growth. Well, 60% of our economy is consumption. If you cast your minds back to uni or high school, GDP, consumption plus investment plus government spending plus net exports, right? Well, 60% is consumption. 60% is us going out, spending, consuming, going to a cafe, getting a haircut, all that good stuff. And this is what they're trying to generate. It's why they want higher asset price. This is what they want. Yeah. You'd be worried if we were going the other way and asset prices were declining.
I remember the last time we spoke for the ASX day, you mentioned that Tina, there is no alternative, and it's really stuck with me when I think about, my investing decisions and when to enter the market or where to put money, and it feels like this is just going to keep going.
Yeah, I mean it's the same sort of anecdotes that you were hearing post-GFC, where inflation was rising, commodity prices recovered quite quickly, and central banks were expected to raise interest rates, and they never got there. And don't forget, the legacy of COVID-19 will be debt, whether it's government debt, whether it's corporate debt, or whether it's household debt. So if the RBA wanted to tap the brakes and cool the Australian economy, they wouldn't have to raise interest rates by too much to have a very large impact, because of the leverage that balance sheets, the leverage that we now have on our balance sheets as a collective.
So Anthony, you've mentioned inflation a fair bit there. You spoke about the need or the RBA trying to bring in wage growth, and there's certainly a debate around inflation being transitory or is it structural. So where does Fidelity sit on that side of the debate?
Yeah, so transitory is definitely the buzzword around inflation at the moment from central banks and economic analysts and commentators. And then, of course, as you mentioned, is it more structural, being more persistent? And definitely, I would suggest that what I'm seeing at the moment is an increasing debate that potentially this is more persistent than what central banks are initially accounted for, given the constraints on the supply side. So what we've seen is demand has recovered very quickly because of the great work that scientists did on the vaccines and rolling out those vaccines. And of course, we had this pent-up demand as Australians couldn't go out and spend to the same extent that they would if the economy was open, having experienced lockdowns in Sydney and Melbourne, for example. So in terms of the work that our analysts have done and our macro team have done, in London and beyond, we think that potentially this inflation may be a little bit more persistent than we had originally anticipated. What you tend to see is that commodity prices recover quite quickly as we exit out of a recession and tend to appreciate in value before supply comes back on stream quite quickly. Now, the difficulty this time around is that whilst the developed world has had great success in rolling out the vaccine, the emerging world, where unlike Australia, of course, but the emerging world is generally the dominant provider of commodities globally. And they're still grappling with this pandemic. So there are still continued supply shortages in commodity chains in particular, but we're seeing that broaden out to other areas as demand has recovered so quickly. So my neighbour's doing renovations on their house like the rest of Sydney, and you talk to the builder and he's just like, Bunnings has run out of lumber and run out of timber. The costs of materials, I'm not making money on this job because the quote I put in was predicated on this cost of materials, and the costs are rising so quickly. And it's not just a Australia phenomenon, it's the rest of the world as well. So now what I want to see if I expect inflation to rise more materially is like the RBA wages growth. Because essentially what happens if inflation is rising, consumers will have a substitution effect where they will substitute out one item for another item. So you might like Mars bars and they're inflating, and well, okay, that's too expensive. I'm going to buy Snickers now. So if you do have that wage growth coming through, consumers or companies can pass on rising costs to the end consumer. That's when you really start to see inflation ramp up. So this is what we call demand pull inflation. Demand is pulling inflation higher rather than cost push inflation, which is what happens when commodities rise appreciably and you see petrol prices and so on rise quite quickly. So, I mean, the construction of the consumer price index is dominated by food and energy prices. So central banks tend to exclude those when they think about what the overall level of prices are doing. But it is a huge debate going on in the markets because essentially central banks target inflation, and if inflation is more sticky, more structural than they originally anticipated, well, they are what we call behind the curve. So the yield curve has shifted on them, and they're trying to slow down the economy by raising interest rates, and that has implications for all asset classes, right from fixed income to equities, and particularly those growthy stocks that everyone loves, and their valuations predicated on low interest rates forever, for example.
So if we start with inflation, then the conversation moves to interest rates, as you just touched on, and then what that means to bond markets, and then I guess what that means to equity markets. It's all a big interrelated chain, and I guess for a lot of investors, especially new investors, it's difficult to get your head around how that's all connected and what it all means. So you're a cross-asset specialist, so we're going to try and pick your brains and try and understand it all. So if we start with the first link in that chain, inflation to interest rates, if inflation is more structural, if wages rise, it's very hard for employers to push wages back down like that. Yeah. That becomes very sticky. What will that mean for interest rates? And then, where does it sort of go from there?
Yeah, I mean, why inflation is so important is obviously it's what central banks target. Not despite I think that they've evolved their mandates to looking at generating full employment now as well. But why it's important is because you're trying to generate in your investment portfolios a return above inflation. Otherwise, inflation acts as a stealth tax. It acts in eroding your standard of living because you're spending more money on items and you obviously have less capital to deploy elsewhere in your consumption habits. So, I mean, the RBA will tell you, we've cut interest rates because inflation is low and we're worried about meeting our inflation objective. But if you talk to your friends, even what your own experiences are, you're probably saying, look, I don't know what they're talking about. Inflation, we had the numbers out recently, 3% year on year. Like 3%, no way. Yeah. Inflation's way higher than that. And it comes back to how the statistician, the ABS, constructs the consumer price index. It's not a cost of living index. Everyone has a different cost of living. Yeah. It's a measure of the overall level of goods and services in the economy. And 25% of that index is new housing costs. So when's the last time you built a new house?
Yesterday.
25% of that index, right?
Yeah, it's crazy.
It's the largest weight within the CPI. So for investors, you can't really rely upon the CPI as a measure of how prices are rising. You need to construct your own cost of living. And, someone with me with 3 kids, my cost of living is going to be very different to a university student, to a retiree, to the different cohorts of society. And not only that, the ABS, what they also do is they hedonically adjust items within the consumer price index. So they'll say that tech is 90% cheaper than it was in the year 2000. Well, I'm not sure if you see what iPhones are doing, but and that's because they're getting better, right? The quality of the camera, or the advancements in motor vehicles.
1 megabyte of storage might be 90% cheaper than it was in 2000.
Yeah,
but the actual phone is not. Yeah.
So when you're an investor, you're thinking, right, I'm trying to develop a portfolio that's diversified, that will generate a return above the level of inflation, so that I'm not suffering the impacts of higher inflation, and I can protect my standard of living from that. Now, as I mentioned, not only does the statistician heavily manipulate the consumer price index, which is it is what it is. It's not right. It's not wrong. But the Reserve Bank of Australia also have their own measures of inflation called trimmed mean and weighted median, which cuts out all the volatile stuff, essentially. But you still have to pay, to fill your car. If they're going to cut out food and energy, well, you still got to pay for groceries. You still got to pay for the petrol. And that generally shows a much more muted rise in inflation pressures within the Australian economy. So, the market is getting all excited at the moment, really led from offshore factors that interest rates are going to rise. To tell you the truth, over the last 20, 30 years, the market always thinks that interest rates are going to rise. If you're looking at that past history, it never happens. Interest rates only go lower. This time around, the RBA and Governor Phil Lowe has been very clear that they want wages growth, and they want inflation, as they measure it by the CPI and their core measures, to be in the mid part of their 2 to 3% inflation band for around 6 months before they raise interest rates. So what that means is when you do see interest rate hikes coming through, and the RBA is telling us they don't expect that to happen until 2024, let the good times roll, right? If that's the case. And even then, as I mentioned, because of how much leverage is in our economy, I don't expect that they're going to be raising interest rates to 5%, in the next decade or anything like that. It might be, 25, 50 basis points, 75 tops, depending upon how the global economy recovers from this pandemic. But what that means is for those investors that own fixed income assets like government bonds or corporate bonds, rising rates generally represent a headwind to performance for those assets. And we've had quite a big bear market in the Australian government bond market since August, where investors in Australian government bonds have lost 3% since August 31, which doesn't sound much as an equity investor, but for an asset that's meant to be uncorrelated, and to give you some context, any time the fixed income market loses money is a bear market. And the reason for that is the yield on government bonds is so low now that it doesn't protect you from rising rates. And if you're a German investor, you can lend to the German government for minus 45 basis points. So you can pay for the privilege. And this is the weird world we're in. And of course, the RBA is the huge buyer in the market as well. So they're in the market buying government bonds too. So it's just a really strange world. And investors, like I said, I was looking at term deposit rates and things like that. I don't see, apart from the safety of having your money in a bank, you're getting the same return putting it under your mattress. And if it's a negative deposit rate, like there is in parts of Europe, well, you're better off having your money in cash and putting it in a safe than paying for the fees for the
Well,
the bank.
On that, because people are probably hearing negative yielding bonds and thinking, why is anyone lending their money to like a German government? What would the logic be for an investor to say, rather than putting this under a mattress or another government bond around the world, like why would I lend it to the German government and get less back?
So there's a few reasons. Firstly, the European Central Bank they have a stance of minus 50 basis points in terms of depositing with the ECB. That's their interest rate. Ours is 10 basis points, 0.1%. So if I invest to the German government, well, that's minus 45 basis points. So I'm making a five basis point pickup. The other reason is I might be mandated to do it. I have to own government bonds if I'm a bank or an insurance company, and I need to own that safety in terms of my balance sheet, the capital requirements that are regulatory. Additionally, I might have to liability match if I'm an insurer or a pension fund. So I have to, it's a fixed bid for AAA safe haven assets. The other reason is comes down to, well, I think that someone will buy this bond off me for a more expensive price in the future. So there's a few reasons. It's not totally nonsensical. Depending upon your outlook. If you thought there was a recession on the horizon, the best asset to own would be long dated, so 30-year maturity Australian government bonds. They're very high credit quality, very low yield, but those yields could go to zero, representing a substantial total return if that eventuality was to play out, which is on the low probability in our estimation. But in a deflation recessionary world, that's what you want to own, government bonds.
So, Anthony, you've in the presentation you mentioned that we're in a marathon, not a sprint, and you said the easy money has been made. Markets are now in a marathon race to deliver returns. What do you mean by this?
Yeah, so in terms of investor psychology or the history of markets, what you tend to find is that the markets, equity markets in particular, accelerate out of a recession. This is when the best performance is generated. As the cycle bottoms, and that investor psychology coming through, oh, hell, I'm selling, and everyone sells. Eventually there's a bottom and the market can recover very quickly from you, which is why sometimes the best thing to do is actually to turn off the financial media, turn off the news, close your eyes, try and sleep well at night and, maintain that long-term preference of investing, extending your time horizon. Essentially, if you invested in the ASX 200 on any given day, there's a 54% probability that it's going to be up on that day because markets trend higher over time in total return terms. If you invest with a horizon of 5 years or more, historically speaking, you've never lost money in the ASX 200 in total return terms.
That's a great start.
Yeah.
That's a clip that and make it the top of the show notes and put it on the page of the website start. Yeah.
So, even if you invest the day before the sell-off of COVID-19, obviously the market is much higher now, and then you get that income coming in as companies have begun to issue dividends as they recovered. Even the banks have also been issuing dividends because they've been having quite a good time as well with the rise in house prices. But you move from that early cycle to mid-cycle, where you start to move into a trending market and it starts to sort of flatline a bit, and those accelerating gains begin to slow because of concerns about rising interest rates or inflation or the prospects for particular sectors or particular companies. So you have to be a lot more discerning with the construction of the portfolio and identifying which companies are likely to do well in a slowing economic growth environment. And so that's what I mean, that, we really, if you were to come from Mars, land down in Sydney or Melbourne or Brisbane or wherever you are in Australia, and, the only information you had was the ASX 200, a chart of the ASX 200, the price point, let's say on the 1st of Jan 2020 and the price point today, and look at those two numbers, you would have thought, things are going great. And you look at the Australian economy, growth's been pretty strong, particularly given how much success we had at initially containing the spread of COVID-19. The unemployment rate has a 5 handle or 4 handle on it at the moment. Inflation is only 3%. You think that things are pretty rosy. You wouldn't even know that we've all lived through such a seismic event over the last couple of years and continue to live through it. With it, our borders aren't even open yet. So when I say, that early money, that sprint money that's been made, we think we're moving into an environment where the gains will be tougher to come by. And we call this a sort of mid-cycle type environment. We still think that the global business cycle has a lot longer runway ahead of it, further growth to come. But certainly there are some storm clouds on the horizon which suggests that volatility for equity markets may pick up. And we've seen that in the last couple of months, particularly with concerns around some things that are going on in China, some things that are going in the US, concerns around the Fed tapering its asset purchases. We're seeing central banks begin to raise interest rates. The Reserve Bank of New Zealand hiked rates. The Bank of Norway hiked rates, and concerns around inflation as well.
Well, Anthony, it feels like everything in equity markets is a sprint these days. We had the fastest decline in history. We had the fastest recovery. Everything just seems to be going so quickly. It might be nice to just take a breath and settle into the slow pace of a marathon rather than a sprint. But I guess the question that comes out of that is, how do you approach that as an investor? The easy money from the immediate recovery has been made, but it sounds like you're still relatively bullish. You're definitely bullish long term. So Bryce and I are trying to figure out what the hell to do with the money that we're saving. You obviously, Fidelity runs hundreds of funds, so there's not a one-size-fits-all answer. But what are some rules of thumb that we can take and apply to our portfolios?
Yeah, I wrote a paper on this in April last year, just when there was so much volatility in markets, and for financial advisors to use with their clients, but also for our direct investors. And, it really comes back to the old rules. I guess it'd be quite dull. The exciting thing is chasing coin, right? Chasing that quick win. And, looking for those double baggers, triple baggers. I think James and Maroon were talking about 500 baggers. Good luck, if you can find that type of thing. And that's really doing, your homework, your due diligence, but importantly, being very patient, what we call patient capital. But it comes back to the old chestnuts of diversification, thinking about how you construct your equity portfolios, that there's not too much embedded risk in terms of correlations. So if one sector or one company is doing poorly, hopefully that's immune from the rest of the portfolios in your rest of companies in your portfolios. And academic literature suggests that you can diversify appropriately with as few as 12 to 16 companies. 12 to 16 stocks, so it doesn't take much.
Importantly, that doesn't mean the 12 buy now, pay later.
Exactly, yeah, exactly. So, PayPal have come in, or Amazon have come in, and what's that going to do? And you obviously, the news, for example, the other day that Hertz have put a big order in with Tesla, and you get those sort of short-term noise, short-term volatility. And that brings me on to my second point, extending your time horizon from a day, a week, a month, a year, to thinking about long-term capital accumulation. And this is really how the very wealthy think. Family offices that I meet with, endowments, long-term capital. Thinking 50 years, generational wealth, and building that and using that power of compounding in your favor. And the great thing, I come across many investors and they'll say, I'm a long-term investor, but their investment time horizons go from years to months to weeks to days in the most volatile markets. When they see the value of their portfolios down in the ASX, 30%, they're like, oh, God. And they normally sell at precisely the wrong time, behaviorally. So, diversification, also extending your time horizon, and thirdly, I would say, you're going to expect this from someone that works for Fidelity International, but being active and being what we call active, doing triathlons and doing nice.
Bryce is about to do a 150k bike ride.
Nice, Bryce. Good one. Yeah. When I say be active, obviously looking after your health is probably the best investment you can make. Second is education, but when we're talking about investment portfolios and we talk about what we describe active fund management rather than passive fund management, and that's being highly selective and not allocating capital to every company in the index, which is generally the index is constructed to some arbitrary rules about how big a company is or various other ways and means. But we think that there are areas of markets which are inefficient, and we're doing bottom-up homework, due diligence, fundamental analysis, all the good stuff that James and Maroon spoke about a couple of weeks ago, the stuff that they do with our analyst team is one way to identify the winners and potentially avoid those losers. Whereas opposed to buying a passive index, and we've got no issue. We have passive funds as well at Fidelity Offshore. They can be definitely very appropriate for investors as well, and particularly given the low fees that they charge. But there are parts of this investment world where you want to take a more active approach. And good luck for the 150k flight ride.
Thank you.
Nice one.
Now, Anthony, to close out the conversation, we want to touch on demographics briefly. You mentioned in your presentation that it's going to play a very important part in, how the investment landscape is going to shape up over the next few decades. Are you able to expand on what you mean by this?
Yeah, so I think that the next decade or so for Australians will be characterised by investors looking further afield for returns, and they've historically had to look. We've been very spoiled by having a relatively higher interest rate in Australia. We've been pretty spoiled by how well the ASX 200 has performed. And we've also been spoiled because we have the fourth largest pool of savings in the world in our superannuation industry. And that naturally has quite a high bias to Aussie equities as well. So you've seen this every time you get paid your salary and the necessary 9.5%, 10% goes into your super fund, inevitably a balanced fund will buy some portion of Aussie equities with that as well. So that's a very strong technical bid for the market going higher. Now, I think going forward, Australians looking further afield, they'll be looking at emerging market equities, they'll be looking at Asian equities, they'll be looking at global equities and potentially some more niche style funds. I also think that thematic funds will also be appealing to Australian investors. You've seen that in the ETF space, but also fund managers like Fidelity provide access to products that tap into some of these themes as well. And I think that demographics is a very powerful theme because I can talk to you now, we'll come back in a year's time and everything might have been right. More likely, I've got some things right, I've got some things wrong. Hopefully I haven't got everything wrong. And that's the beauty of publishing views in black and white, writing them down, but also talking in podcasts these days or doing interviews. And with those short-term factors, they are very difficult to predict, despite them being closer in the time horizon. Sometimes it's far easier to predict the long run, the long term. And demographic trends are actually quite easy, not easy, but we can be quite accurate with our predictions. And with that, we think we're living longer, we're living better, and there's going to be more of us in this globe going forward. So we think about how can we construct a portfolio that will tap into some of those themes: living longer, living better, and living healthier. There's more of us, of course. And we think that this is a trend, a demographic trend that certainly companies can look at, but also investors in providing capital to these companies to benefit and generate those long-term sustainable returns that will help them meet their investment and savings goals going forward. So again, I guess I've spoken a lot today about extending your time horizon. I think allocating to something that potentially taps into those themes of demographics, which are predictable, and seeing which are the innovative companies that are likely to potentially benefit from some of these trends is one way that investors could potentially generate those returns that they require going forward.
Yeah, I mean, the impact of demographics can be seen in the very short term if you look at like Coles and Woolies and their commentary around population growth and immigration and what that's going to do to like their top line. And, because there's going to be less immigration, it's going to affect them this year, next year. But then if you extend that over decades and you extrapolate that, some of those population trends, you see just how important that will be for companies' fortunes.
Yeah, especially in the emerging world as well, right? Where they're still developing and they're still moving up in terms of their standards of living to what we enjoy here in developed markets.
Yeah.
Whether that's online penetration or access to the internet, or access to simple insurance products, access to healthcare. There are companies all along this way that stand to benefit from some of those trends that are more predictable, like demographics.
Yeah. So, Anthony, we have come to the end of our time. We want to thank you for joining us today. If people want to hear more from you, they should head to the ASX website and listen to your full presentation. And I'm sure if they jump on the Fidelity website, they can read a lot more of what you've written.
Yes, and access to webinars and all sorts of things where I interview portfolio managers and analysts. But yeah, look at the ASX presentation. It's a cracker.
If you say so
yourself. I'm sure they'll enjoy it. Yeah, if I say so myself, please give some kind feedback as well. That'll be nice. My boss will like that.
Yeah. Well, we'll get stuck into these final 3 questions. We have asked you before, but you've told us you've come with new answers. So
Yes.
if people want to go back and listen to your old interview, they can compare the pair.
Yes.
But we'll start with the first one. Do you have any books that you consider must read?
Yes, so I've got 2 for you, and stepping outside of the finance world a little bit, because I know that you get a lot of finance book recommendations, and my job is reading a lot, so I like to tune out from that sometimes. So you probably had Shoe Dog, Phil Knight, recommended before. So I thought that was just a fantastic
Cracking book.
story. But my other book that I just finished, and this is for Bryce, is a book called Iron War, The Greatest Race Ever Run. Have you ever had that one recommended to you?
No.
So this is Jensen Button's favourite book. And I heard he might be good for your podcast as well. So I heard him on a podcast, the F1 racer.
Yeah.
And this is a story of these 2 gun athletes in the 80s, Dave Scott and Mark Allen. And it was the early days of the Ironman triathlons, and these 2 guys just going at it, and this story, all their background, and they basically, I don't want to give it away, but they were neck and neck this whole Ironman, which is, I think, 100. Yeah, it's a marathon at the end.
Marathon,
I think it's a
180k bike.
180k bike. Yeah, so
5k swim or something.
worth definitely pretty inspiring for your bike ride.
Yeah,
but I really enjoyed it.
Close to that.
So yeah, Jensen Button recommended it. I read it. It was really good. Really good read. Really well written. So you have a look at that for those of you that want to be like Bryce.
Love that. Real exercise theme. Shoe Dog and Iron War.
Yeah.
So second question, what's the best company you've ever come across?
Yeah, so last time I said my dad's company, and he told me not to say that again. So I thought about this. I've got another book, Sam Walton.
Yeah.
Which is Made in America. Yeah, so I thought that, I thought about a great company, whether you're thinking about an Amazon, but Walmart, I think it's like almost $500 billion market cap, starts from a small convenience store in the early 60s. What an amazing story. I think employs over 2 million people today. And obviously, actually, when the piece of research came out from our macro team in London, they were highlighting minimum wage increases in the US. And there are a number of large firms that have subscribe to the $15 an hour minimum wage, and Walmart is one of them. So that can actually have a rising impact on inflationary pressures in the US too, and the US being how important they are in capital markets. The Fed, obviously a lot of central banks will move their monetary conditions depending upon what the Fed is doing too. So, the Walmart effect. You've heard that book before. I didn't think you'd hear it.
So Bryce and I both came up in retail. Like, he was at Woolies, I was at Coles.
Oh, right, yeah.
I remember, that's the book they suggest you read when you start.
Oh, nice,
and
yeah.
I remember reading it, and you're so inspired for retail after
Even
reading
the
it.
techniques he had, loss leaders, and he went against the grain, obviously. And I guess that's how a lot of startups happen. They look at what the incumbents do, what they are. What can we do differently? And even something as simple as buy now, pay later. Lay-by. Oh, let's do that. It's like I remember Mum going into Target and lay-buying stuff. Teenage Mutant Ninja Turtle shirts and stuff. So
And you think Coles and Woolies are big retailers, but then you look at the revenue that Walmart's generating. Was it almost 600 billion or something ridiculous?
Yeah.
2 million people. It's just like,
What a story, right?
crazy. It's crazy.
Yeah.
So good company.
Yeah,
I
good
think.
company.
Yeah.
And what the American operation was run by a New Zealander, ex-Woolies, Greg Foran. We have tried to get him on the show many times and no luck.
Oh, really?
So
He'll be listening to this.
if he's
Come on,
listening,
Greg.
come on.
The guys are nice. They give you a cup of water.
Yeah. What can you ask for? He's now the CEO of Air New Zealand, so he's pretty busy. But
Come on. Well, yeah. Borders are coming down soon. You
True,
can come over.
Yeah. And then Anthony, final question. If you think back to your younger self, getting that Teenage Mutant Ninja Turtle shirt from Target on lay-by, what advice would you give to your younger self?
Like relation to the industry or...
Well, finance, investing,
Yeah.
or life more generally, if you've got any words of wisdom. you
Yeah,
wanna share.
I think I gave you a good answer last time with, just trying different things out and experiencing and definitely, one thing I always say is travel, definitely, if you get the chance, having spent a lot of time overseas. But I was thinking about this coming in today and my first job was at Macquarie Bank. And I remember working on the floor with the equity investors and the fixed income investors. And I remember just annoying a lot of people, just asking them lots of questions, but also generally making myself a bit of a pest. In those days, the brokers used to send all their reports physically rather than send them via PDF or email. And I used to go over to the equity desk and read the reports and ask them questions about companies and things like that. So the next piece of advice I'm going to give you, your first piece, you can listen to the other podcast, but this podcast, it would be, go and ask lots of questions of more senior people within your organization and build up a strong network. Because I think half the game in investment management is being enthusiastic and putting your hand up to do things. And I still have, lunches and catch-ups with people that I worked with at Macquarie in 2002, 2003. So I think that's a really great way for you to get into the industry, know the industry, and you never know what opportunities might develop from having a very strong network of peers and that enthusiasm. If you have enthusiasm, you're halfway there, I think, to being successful.
Yeah, love that.
Love it, Anthony. Well, as always, it's been incredibly insightful chatting with you. I know that a lot of the big questions and debates around at the moment, are certainly playing on the mind of the Equimates community. So you've hopefully helped us unpack it and understand it a little bit more. So, as always, a pleasure. A reminder, if you want to check out Anthony's presentation, head to the link in the show notes or the ASX website, search Investor Day, and you can follow what he's doing at the Fidelity website as well. But Anthony, thank you very much.
Cheers, thank you.